On Canberra Live with Leon Delaney. Money Matters with Luke Smith from Envision Financial Services.
Well, that'd be you, Mr. Luke Smith. Thanks very much for wandering into the studio this afternoon.
No dramas. It's nice and cool in here for a change. It's
Why does it look like you've just wandered off the golf course?
No, not at all. I was working this morning.
Is that what it was?
Yeah, that's it.
It's Casual Friday.
Let's call it working.
Casual Friday, I know.
We were walking around somewhere talking finance. I think that's working.
It sounds like work, doesn't it? Absolutely. You know what they say about golf, though, don't you? It's a good walk ruined.
Yeah, today I'll totally agree with that. I'll agree with that most weeks.
For sure. Today we're asking the question, can I gift money or assets to my children?
Yep.
I'll take a wild stab in the dark and suggest yes, you can, but there may be consequences.
Exactly right. So, we spoke recently about the asset test, and we'll sort of continue that Centerlink theme leading into Christmas because I'm getting this one more and more. From a structural perspective, yes, you can gift anybody anything you want. And I think the first line we need to draw is, why are we doing it? Who are we doing it to? And what are the implications? Can I pull money out of my super over 60 and give it to my kids to buy a house? 100%. Can I sell an investment property? Can I get the cash? Can I give that to my kids to have a birthday? Sure. You can give your kids anything you want. It is not a tax event in the recipient's hands. It's a capital event. Okay, so I have a lot of people come in and go, but if I give my kids $50,000 for a house, I'm going to pay tax. The only tax you need to consider from a gifting perspective is, did you incur tax selling that asset? If the answer is no, or you've got the cash, give it to your kids. No problems. That's great. Would I give it? No. Would I loan it? 100%. Because if you give money to some kids and your daughter goes and buys a house with a boyfriend, then they break up and there's no formal loan around that money going into that transaction, you've potentially lost your cash. If you've lent the money in with a formal loan arrangement, there's a very high likelihood that you get made whole and then they can fight over whatever's left. So that you can do at any time with anything. Gifting and deeming, now we're talking Centerlink. So the tax department don't care what you gift.
Yeah, because there's no gift tax in Australia.
Exactly.
You can give whatever you like to whomever you like.
Spot on.
But there are other issues to consider. And as you've just pointed out, if you're providing money to your offspring to help them buy a house, you've said enter into a loan arrangement. It's important to make sure that's properly documented in a way that can be produced as evidence in the case of any dispute.
Exactly right.
But then let's move on to the Centerlink.
Yeah, so then we say, okay, I've given my daughter $20,000 to buy a house. What are the implications for me from a Centerlink perspective? And this is where people need to draw a line in the sand and say, okay, I've gifted the money. Does it matter for me? No. Does it matter for how Centerlink view my situation? Yes, 100% it does. And the gifting rules are that you can gift $10,000 in a financial year, $30,000 over a rolling 5-year period, and anything that you gift that exceeds that limit, you are deemed to own and are assessed as the owner of for the next 5 years. So, yes, you can give anything you want to anyone. Centerlink don't preclude you from doing that. I've had people come in the last 2 weeks and go, well, I can't gift that to the kids. Centerlink will get upset. Centerlink don't care what you do. They just want to make a fair and reasonable assessment of your asset position when they're assessing your eligibility for certain things. One of them is primarily the age pension. Now, that assessment can also come into play for other things like care allowances, disability, all sorts of other stuff. There will be assessment of assets because there are a number of tests that they have that use a similar philosophy in relation to income test and asset test. I gave $50,000 to my daughter to buy a house. $40,000 of that is going to be deemed to be mine for the next 5 years. So when they sit down and they say, what do you have in super? What do you have in the bank? What do you have here? What do you have there? Oh, and we're going to include you to have $40,000 under the asset test of the $50,000 that you gave away.
You know, that's just another reason not to make it a gift and to make it an official loan, because then you still own the money.
True, but don't call me out on a Friday afternoon as to how I'll investigate how Centerlink deem a loan, but I would say they're probably still going to say that it's yours.
Yeah, well, that's right. It is still yours.
Yeah, but they're going to then deem for you to
They
share
will,
you
of
still
course.
have it. Yeah, exactly.
They will.
So
you're not going to get out of anything by doing that. It's just that it helps to protect your
Totally.
position.
And that's it. It's the protection of that.
Yeah.
You've still given it away. It'd still be deemed under the gifting rules.
And if you're going to be deemed that you still own it anyway, you might as well actually own it.
Correct.
Yeah.
100%. Just tell them to do it tough because they don't deserve a house and, use whatever.
Oh, come on now. It's not like that
Use
anymore.
whatever silly legislation they're passing to get a house. If something comes back, you can then have a reassessment of that position. Okay, but I just want to sort of bang over that giving it to your kids is not a taxable event. It's not an issue. If you've sold something, then yes, you may have a tax issue for the transaction that you've undertaken to realise that money. But nothing stops you gifting or giving anybody anything. That's fine. Now, moving money between spouses does not trigger the gifting rules. So, as we discussed the other day, if I was 67 and my wife was 60, I wouldn't be having any money in my super fund that is detrimental to my assessment of the asset test. I'd be pulling it out tax-free. I'd be looking to make a non-concessional contribution to my wife because accumulated super under the asset test rules, when my wife is not age pension age, means the assets in her name are exempt. But people go, well, if I move it there, it's going to be gifted. No. Gifting is to external, outside of the family unit, i.e. partner. Kids, yes, it's going to affect. So it's not like I'm not saying you can give the money to the kids. You as a couple, and whatever your relationship looks like, you give it outside of that, the gifting rules are going to apply. So if you want to try and be strategic, if you were 61 or 62 and you had significant assets that potentially you were going to move into someone else's name, or you were going to sell and liquidate and then use the proceeds and not own the asset, Centerlink gifting rules and Centerlink asset test is not something you think about 5 minutes before you walk into Centerlink. If you want to be strategic about this, you've got to look at the ownership of assets in other entities. Then you've got to potentially look at the control of those entities. But it's something that you need to have a long-term view on if your primary objective in life is to maximise your entitlements under the age pension rules and regulations. But I find 95% of people think that there's a tax impost, gifting, and that they can't. We just got to confirm with people. It's just in the eyes of Centerlink. In a general sense, you can do whatever you like.
Yeah.
You also then need to think about the control from an estate perspective. So here's a potential problem. Mum and dad die. I inherit $1 million and I want to give it to my kids so they can go and buy a house. It's come to me. It's mine. I've now got an asset problem. I give it to my kids. Still my asset problem. So if we want to get really creative here, we want to be thinking about what does mum and dad's will do? And this is where, you need some good estate planning advice. If you know, okay, if I inherit anything, it's going to go to my kids. Let's have mum and dad give it straight to the kids and cut me out, because then I haven't blown up my asset test and the eventual recipient has still got the capital and achieved what I want to achieve. So I think there's a huge opportunity here from an estate perspective for people to be thinking about where does the money go through a will and the control of estate proceeds. Because the traditional thinking is mum and dad die, I get it, I give it to my kids. Oh, hang on, now I'm 67 and I can't get Centerlink for assets that I don't have, that I never intentionally wanted. So I think, again, be out there thinking about your estate planning and the flow of proceeds. Yes, it's morbid. Yes, you don't want to talk about it after 9 beers, but be mindful of it, because age pension at the moment is $46,000 combined. $46,000. And you inherit something, give it to your kids, and you don't get that for 5 years. It's over $200,000. So it's significant. So think about what happens above you, not just below you, from a generational perspective. And then control what you can control to direct and manage the ownership of assets so that you don't potentially blow yourself up from a Centerlink perspective. But if you are going to do something, do it well before that 5-year rule because they're going to ask you, have you given anything away in the last 5 years? No, I haven't, because I gave $750,000 away 6 years ago. Great, full age pension, happy days. No harm, no foul, you haven't broken any rules. So be thinking, if you're 60, 61, 62, be thinking now about the structure of your assets, because it could have significant implications in the not too distant future, because 5 years leading in is a long time.
So if you've got so many assets that you're not going to need the age pension, I guess this discussion doesn't matter.
Not at all.
But if you have, let's say, modest superannuation assets, good, but not quite good enough,
Correct.
then most people find themselves in a place where they're going to want to draw some aged pension from Centerlink, if not the full age pension from Centerlink. And in order to do that, you really do have to pass the asset test as well as the income test.
Totally.
And that's why you need to be careful about giving away assets.
Exactly, because 470-odd thousand is the minimum asset test now for full age pension. And if you've blown right over because of inheritance, or you've got assets leading up to that time that you could have restructured strategically, and you don't, well, whose fault's that?
Indeed. And of course, the other benefit of qualifying for a part-aged pension, even if it's only a few dollars, the other benefit is the concession card that comes with it.
Yeah, there's $5,000, $6,000, $7,000, $8,000 of value there, from licenses to rates to this to that to all sorts of stuff that everybody wants the pharmaceutical PBS and the cheap medicines, and that's great. But there's all sorts of other benefits that come with it. Yeah. So it's not just thinking about you, it's thinking about you and your partner and how you fit on that journey, because that could be a 67, 77, 80, it could be a 20-year journey or more. So it's worth planning well ahead. So I'd almost say to people, okay, you're going to retire. We're 4, 5, 6, 7 years out now. Well, is it a problem? No, I've got $5 million in super. Okay, great. Not even a conversation. But if you've got assets that could get you in no man's land, which is $800 to $1 million, where you're right up on the cusp where you just get nothing, you would actually mathematically be better off having $500,000 in super and getting full age pension. You'd actually be better off than having $1 million and getting next to nothing and then having to fund yourself completely. So again, that's why we're raising. Be strategic about this, because it's a tool at your disposal.
Luke Smith from Envision Financial is with me in the studio this afternoon. We're asking the question, can I gift money or assets to my children? We'll be back with more in just a moment. Well, it's about 7 minutes to 5 now. Luke Smith from Envision Financial is with me in the studio this afternoon, and we're talking about, can I gift money or assets to my children? I think we've established, yes, you can, but if you want to draw a Centerlink pension, there may be consequences.
Exactly right. And I think we just sort of clarify here, if I read this, a gift includes giving something away, transferring ownership, donates money, sells an asset for less than market value, or purchases, or the purchase of an asset and gets a disproportional ownership of the asset. So even if you sell something under market value, they have the right to deem the difference to the market value as an asset. So again, it's not just the act of giving away money, it's the transfer of physical assets or other properties and a range of other things. So be mindful of that, because I think it's important to understand what you're doing, and it's more important to understand the implications of it. And again, if you want to do that and you understand what that'll do to your assessment, okay, fine. No problem. We're not saying don't do it. We're just saying go into something aware that, okay, if I'm going to give something away, it's going to be assessed for 5 years. If I transfer an asset between a spouse, then it's not a gift. You can do that, and that's not a problem. You'll be deemed on the asset, and that will affect the income test, because they will deem a rate of earnings on that asset, and that income is then applied to the income test under the Centerlink rules. There's no tax to give anything away. So again, if we separate Centerlink from giving, you can give anybody anything, that's fine. The only potential tax implication is the sale of the asset that you may have liquidated for you. So you always need to consider that. But I think if people can go into this with their eyes open and keep that 5-year window in check, then you've got the ability to make the most of some strategic planning. And at the end of the day, if you're fortunate enough to get enough that Centerlink doesn't matter. Also need to keep in mind, I have this one a lot this week. Well, I'll never get it. Well, no, you just don't get it right now. You can go and live and do your thing and spend it, whatever you want to spend for the next 3 or 4 years. Stroll back in with another assessment. You might be eligible. So don't panic that, oh, well, I'm never going to be eligible for the age pension. It's just, remember, it's an assessment on the day you go in there. That's not forever. You can go and have some amazing holidays and do some amazing renovations on your home and hurl a whole lot of money into unassessable assets. Stroll back in and go, hey, I just got rid of 500 grand. Now, would you get rid of 500 grand to get a little bit of age pension for the capital you've foregone? Probably not, but some people believe it's their right to get it, and okay, that's their view. And I'm
yeah, sure, but I can certainly see it as perfectly legitimate to go on a grand holiday, which actually costs a lot of money, because that's what people want to do when they retire.
Well,
they want to go and
travel.
travel.
Yeah. 100%. You know, and I say to a lot of my clients, like, let's tie it on from 60 to sort of mid 70s, because I don't have too many clients flying around the world at 94. I've got one that told me I wasn't too big for a slap.
Yes.
She said that to me the other day, but, you know, she's 94 and full of beans and we love her. But, you know, it's about now controlling the things that you can to have the choices and the experiences that you've worked a very, very long time to get to the age where you make the most of it. And I think people need to think that, well, Centerlink is an option. It's not a destination for me. It's a byproduct of your output over time. And if you can make the most of these rules without accidentally, like we said before the outbreak with the estate issue, if that's a big problem and a big driver for you and you're in that bracket and you could inherit, I'd be having that conversation with mum and dad to make sure that they don't accidentally blow you up when they could just give the money straight to your kids, because within your family unit, you've agreed that that's what you're going to do.
Where can listeners get more information?
Yeah, so office number 6260-4749. We've got envisionfinancial.com.au on the internet. That's Envision with an E, not an I. We've got the Strategy Stacker, Luke Talks Money on iTunes and Spotify. We've got Envision Financial Canberra on YouTube, where we've got a backlog of all of our shows and people can like and subscribe to that. And we've got Smart Money Strategy, your ultimate guide to financial planning, with an entire chapter on exactly this.
Indeed. Luke, we'll talk to you again next Friday.
See you next week.
Luke Smith from Envision Financial.